The U.S. underperforming much of the rest of the world to start 2025. iShares ETFs for Europe and China are both up double digits, while the S&P 500 is up about 2.5%. Our next guest says he still prefers domestic stocks to international. Joining us now is Neel Mukherjee, TIAA Chief Investment Officer, who oversees $1.4 trillion in assets under management. It's a lot of money, Neel. It's a lot of money. So tell me about how you're thinking at this time. Well, we're under 6K on the S&P. There's been some broadening in this market away from Apple, Google, Microsoft, Nvidia, which I guess would be a good health sign for the market, but a lot of uncertainty over what policy is going to be, and with rates stubbornly high, whether stocks can move higher. Why do you believe in the U.S. still?
Well, the growth story, John, first of all, thanks for having me. It's always great to be with you. The U.S. growth story, I think, is still a very good one. There's some nervousness in the marketplace with respect to loss of momentum in U.S. growth. I just think we might be going through a bit of a soft patch. We pulled in a lot of that growth momentum into the fourth quarter of last year. We saw massive spike in consumer spending over the holidays. So a bit of a soft patch is to be expected. But it's still a 2% economy, which is pretty good. The labor market seems resilient. It's slowing down in a controlled fashion. The high-income consumer is spending. They're being supported by a high level of net worth. They're earning good returns on their cash on the sidelines. But also, we're watching some key risks in this economy. So you think about the policy uncertainty. You talked about the higher interest rates. Small businesses are under pressure because of higher funding costs. The housing market is a bit stalled out as well because of affordability issues. But net, this economy still seems to have a 2% like growth built into it. And don't forget, the prospect of deregulation, reshoring, et cetera, and business confidence, which is rising, that can support this economy going forward. So we remain optimistic on the U.S., but there's some catalyst coming through for international as well.
So I hear you about the U.S. economy overall, 2% being pretty good, but at the same time, the U.S. stock market, these indices, the valuations are pretty darn strong. So why is now a good time to be in and put more into domestic stocks versus other places? We just heard Christina Hooper making an argument for Europe and maybe even China.
Yeah, it's a great question. So we remain invested in the U.S., but we do feel that the market is ripe for a little bit more rotation. So at the index level, there may not be too much excitement in 2025, but below the surface, because of this profit broadening story and the prospect for deregulation, means that the non-Mag 7 names may have a better year than the Mag 7 names. So think of areas like value and banks and utilities, even travel names, which are doing quite well, utilities as well, which could do well for the rest of this year. But I agree with you. We're keeping a close eye on international. Valuations are quite cheap there to begin with. Sentiment was quite bearish at the beginning of this year. And there are some catalysts that are coming through. So, for example, the potential ceasefire in Ukraine, ECB could ease going forward. There's a resurgence in enthusiasm for Chinese technology names as well. So we're watching this closely. And I do feel that in the next few months, you could see this continue a little bit more. But I wouldn't remove your chips from U.S. equities as of now because the prospects are still pretty good.